Fiqh al-Muamalat is crucial for Muslims as it covers contract, loans, business, and trade activities. Any economic deal violating Sharia principle is considered invalid. To ensure a transaction is by Islamic law, it is crucial to recognize and avoid the prohibited elements. Islamic finance principles of riba, gharar, and maisir guide financial transactions based on fairness, transparency, and avoiding exploitative or harmful practices. Riba prohibits interest sharing, gharar prohibits excessive uncertainty, and maisir discourages speculative transactions. In this video, we will highlight three main parts of understanding prohibited elements in contemporary finance. The first one would be in-depth of the prohibited elements from Sharia perspective. The next one would be making conventional finance Sharia compliant. And last but not least is choosing the right product in conventional finance. The first prohibited elements we'll discuss is riba, an interest-based gain seen as unfair and exploitative. Riba includes riba an-nasi'ah and riba al-fadl, both condemned by the Quran. We will examine their implications in modern finance. Riba an-nasi'ah is the initial fee set for a loan, often leading to unfair profits. Even though some argue its legality in certain scenarios, such as when it is conducted by traditional banks for investment or production, the general restriction from the Quran remains.
وَأَخْذِهِمُ الرِّبَا وَقَدْ نُهُوا عَنْهُ وَأَكْلِهِمْ أَمْوَالَ النَّاسِ بِالْبَاطِلِ وَأَعْتَدْنَا لِلْكَافِرِينَ مِنْهُمْ عَذَابًا أَلِيمًا.
In Surah An-Nisa verse 161, which means, and for their charging riba, usury or interest, while they were forbidden from it, and for their devouring of the properties of the people by false means, we have prepared for the disbelievers among them a painful punishment. Riba al-fadl, or illegal access, can be determined through weight or measure in an exchange between two counter values. Anything that one of the two parties to a trading transaction unjustly receives as an addition is known as riba al-fadl. This is the hadith that serves as the foundation for the ban of this type of riba and its implications in contemporary business. Dr. Khalid Zahir suggests in one of his writings that Muslim scholars have discussed how the Islamic concept of riba al-fadl, usury in exchange, might apply to modern business transactions. First is same currency exchange. It could be considered illegal for money changers to exchange the same currency using different terms, like exchanging dollar for dollars. Second is goldsmith transactions. Goldsmiths should exchange old jewelry for new pieces based only on weight, after removing valuable stones without deducting for impurities or charging for production expenses. And third, unique items exchange. When exchanging items in the same category but with unique features, indirect procedures should be used to ensure fairness. Next, moving on to gharar, meaning uncertainty. Transactions involving uncertainty or ambiguity are expressly forbidden. We will examine how gharar impacts various contracts and its relevance to modern e-wallet transactions. The main justifications for gharar prohibitions include potential conflict between parties, false contracts, and illegal property acquisition. For example, an e-wallet transaction may be against the principles of gharar if it has aspects of speculation or unknown consequences, like gambling or ambiguous conditions of purchase. If an e-wallet system ensures transparency and clarity and avoids ambiguity or excessive risk in its transaction, it may align with Islamic financial principles and be considered permissible, which is halal. The third element is maisir, or gambling. We will explore the roots of the term and its strict prohibition in Islam. The term maisir is rooted in the Arabic word yasara and refers to gambling or wagering, as highlighted in the Quran and Hadith. This idea is related to getting money quickly and without effort or exhaustion. Imam Malik and Al-Qurtubi define gambling as including harmful games such as chess or dice and bets or wagers that put anything at risk or demand sacrifices. One of the examples that is widely known is forex trading. Forex trading is the buying and selling of currencies on the foreign exchange market. Although there is a chance for large profits with speculative trading, there are also a lot of threats involved which involve maisir. Another example that is finance related is insurance. Maisir in insurance involves gambling elements, where risk-taking results in loss of premiums. Takaful, which is an Islamic solution, allows participants to receive money back if no danger occurs, using both premium funds and collective donations for potential risks. Lastly, contracts involving forbidden goods or actions are considered invalid in Islamic law. We will discuss why Muslims are discouraged from investing in businesses dealing with prohibited properties and the concept of Sharia screening. In modern finance, Muslims are advised to conduct thorough research before investing in companies that include prohibited properties in their transactions. It is forbidden for Muslims to invest in stocks of businesses that run against Islamic principles, such as traditional banks, casinos, alcoholic beverage producers, sellers of non-halal meat, or organizations providing immoral services, which are the prohibited properties in Muamalat. Sharia screening helps Muslims identify permissible businesses for investment. We will explore the two-step approach involving qualitative and quantitative screening recommended by the Securities Commission Sharia Advisory Council. As we wrap up our exploration of prohibited elements in Fiqh Muamalat, it becomes clear that understanding this principle is essential for a fair and ethical financial system. Why does conventional finance rely on interest-based transactions? Conventional finance relies heavily on interest-based transactions, primarily due to the time value of money and the role of interest rates in facilitating economic activities. The use of interest, also known as riba in Islamic finance, has deep historical roots and has become a foundational element of modern financial systems. Interest is considered compensation for the time value of money. The idea is that the sum of money of today is worth more than the same sum in the future. By charging interest, lenders are compensated for the opportunity cost of not using their funds elsewhere during the loan period. While interest-based transactions have been successful in facilitating economic activities and promoting investment, Islamic finance opposed the concept of interest as exploitative and unjust. Muslims consider interest as a modern equivalent to riba, that is, an income that is not earned or is unfair. The main problem with riba is that from the very start, it represents an unfair situation for one of the two parties in a business transaction or lost. Regardless of the circumstances, Muslims consider that the very concept of an interest rate is inherently unjust either to the lender or the receiver. To circumvent this, sukuk were created in order to link the returns and cash flow of that financing to a specific asset being purchased, effectively distributing the benefits of that asset. This allows investors to work around the prohibition outlined under Sharia and still receive the benefits of that financing. Because of the way that sukuk are structured, financing can only be raised for identifiable assets. Sukuk represents aggregates and undivided shares of ownership in a tangible asset as it relates to a specific project or a specific investment activity. An investor in a sukuk, therefore, does not own a debt obligation owed by the bond issuer, but instead owns a piece of the asset that linked to the investment. This means that sukuk holders, unlike bond holders, receive a portion of the earnings generated by the associated asset. The key differences between sukuk and traditional bonds is that sukuk involves asset ownership, while bonds are a debt obligations. Sukuk are Sharia-compliant investment certificates issued by sovereign and corporate entities to finance their activities. Gharar is generally prohibited under Islam because there are a set of strict rules in Islamic finance against transactions that are highly uncertain or that may cause any injustice or deceit against any of the parties. The justification and guidance for forbidding contracts or transactions considered as gharar comes from the hadith. It contains the saying of the Prophet Mohamed, who spoke against the selling of the birds in the sky, the fish in the water, or the unborn calf in the mother's womb, saying, "Sell not what is not with you." Therefore, questions of gharar arise when the claim of ownership is unclear or suspicious. In finance, gharar is observed within derivative transactions such as forwards, futures, and options, as well as in short selling and other forms of speculation. In Islamic finance, most derivative contracts are forbidden and considered invalid because of the uncertainty involved in the future delivery of the underlying assets. Conventional finances may inadvertently introduce elements of gharar for several reasons. One of it would be financial markets that involve a certain level of risk, and financial institutions often engage in risk management activities. However, the line between risk management and speculation can sometimes become blurred. Nonetheless, Islam prohibits gharar to protect against unexpected losses, disagreements, misunderstandings, and distrust, and consequently promote satisfaction in business dealings. In contrast to conventional finance focused on interest-based loans, Islamic finance centers around profit and loss sharing arrangements. Mudarabah and musyarakah are two prominent concepts where capital is shared between the investor and entrepreneur, aligning incentives and promoting risk-sharing. These principles provide a solid foundation for transforming financial systems into Sharia-compliant structures. An example of how a mudarabah contract has worked effectively can be seen by the Sudanese Abu Halima Greenhouses project of Irada, a microfinance company set up and promoted by Bank Al Khartoum, the largest bank in Sudan. The bank used a restricted mudarabah contract, providing the mudaribs with non-financial services as well as the capital necessary to partake in the project, such as technical training, managerial, and marketing support. Losses were taken by the bank and profits would be shared in the profit ratio of 40% for the micro-entrepreneur and 60% for the bank. Profit distribution would take place twice in a year for 5 years. However, at the end of the 5 years, once the entrepreneurs had been adequately trained, they would retain 100% of the profits, essentially owning the venture. Gambling and all games of chance have been strictly prohibited by the Quran. According to the Quran, in Surah Al-Ma'idah, verse 90 to 91, Allah mentions that gambling, as wine drinking, is the devil's handiwork through which he seeks to cause enmity among the people and turn them away from the remembrance of God. One example of maisir in Islamic finance is the conventional insurance model. These insurance contracts typically involve a high degree of uncertainty, as they are based on potential future events that may or may not occur. This speculative nature, where the policyholder pays a premium without knowing if they will receive a return, constitutes maisir. Hence, it is not permissible in Islamic finance. Instead, Islamic insurance models, also known as takaful, are promoted, where risk is shared among the participants. Takaful is a type of Islamic insurance wherein members contribute money into a pool system to guarantee each other against loss or damage. Takaful branded insurance is based on Sharia or Islamic religious law, which explains how individuals are responsible to cooperate and protect one another. Under the Islamic insurance system, takaful premium is termed as Rasul Mal or takaful contribution. In consideration for participation in the takaful policy, participants are required to pay the takaful operator the contribution regularly. Under the takaful contract, the takaful benefit or manfaat compensations received by unfortunate participants is collected from tabarruk. This conforms to the words of Dr. Qardawi mentioned in this book that tabarruk is termed as donation with a condition of compensation. Hence, tabarruk would allow the participants to perform their deeds in sincerity, assisting fellow participants who might suffer a loss or damage due to a catastrophe or disaster. In view of this, it is possible to indicate that the function of takaful contribution paid by the participants is not similar to the premium paid by the insured under conventional insurance, since the latter paid the premium as a pledge on some uncertain event, while the former paid with intention of donation. Conventional and Islamic financial institutions often offer similar products with one significant difference between them, which is the presence of the prohibited elements in Islamic finance. These prohibited elements are considered intangible and requires additional knowledge to differentiate between the two. Loan or financing is an example of the products offered by both conventional and Islamic banks. Both types of finance take into account the concept of time value of money in different ways. Conventional banks charge interest rates to their customers, while Islamic finance strongly prohibits riba in business transactions. Therefore, Islamic finance proposes profit and loss sharing between banks and debtors to adhere to the Islamic principles according to the teachings of the Quran and Sunnah. This can be made possible by incorporating Islamic banking contracts to ensure every financial transaction eliminates and free from all the prohibited elements, namely riba, gharar, and maisir. In finance, it is crucial for every transaction to bring profit. However, due to the prohibition of riba in the Sharia law, there are extra steps taken to ensure profit gain does not come from interest charged on customer. Therefore, Islamic finance emerged as a system that adheres to the principles of Sharia law. One financial instrument that is the basis of profit making in Islamic finance is a type of murabaha contract, which is tawarruk, or also known as commodity murabaha in the contemporary finance world. Derived from the Arabic word rib, which means profit, the murabaha contract incarnates a cost plus profit sale in Islamic finance, where it eliminates the forbidden element of riba by providing a Sharia-compliant alternative. Tawarruk is a contemporary adaptation of the murabaha contract, where banks, as a financier or creditor, will purchase commodities from a supplier to later sell them to customers or debtors at a cost plus profit price agreed upon upfront. In Malaysia, the most common commodity is crude palm oil or RBD palm oil. In a tawarruk contract, transparency is the key in eliminating excessive speculative uncertainty or gharar. Both parties engage in the product disclosure regarding the profit margin and types of payment, either lump sum or installment, among other clarifications during contract signing. A contemporary example of this financial model is the Maybank Commodity Murabaha Home Financing, where this product offers customers Sharia-compliant financing using the tawarruk contract. It provides flexibility on the profit rates, where customers can choose whether to pay fixed, tiered, or variable profit rates. Contrasting Islamic finance with conventional practices, Maybank also offers a similar product in their conventional window of products, which is the Maybank Maxi Home Financing Purchase. Although both products have similar rates or charges, the critical difference lies in the contractual structure, where the commodity murabaha involves two sales contracts between three parties, ensuring adherence to Sharia principles, whereas the Maxi Home Financing Purchase is a straightforward loan contract, which means the bank implies interest rates on the customer for borrowing their funds. Next, we are going to discuss another contract used in Islamic finance, which is the Bai Bithaman Ajil contract. BBA is directly translated from Arabic as deferred payment sale, offering customers a unique way to acquire assets without the burden of an immediate full payment. The concept of BBA is similar to the conventional practice of installment sales, where it allows customers to obtain an asset without the need for an upfront full payment. Instead, they commit to paying a predetermined amount every month over a specified period. Some may find themselves questioning the difference between BBA and a Murabaha contract. Unlike Murabaha, where the bank acts as an intermediary between commodity providers and buyers, in BBA, the customer directly engage with the bank to acquire assets. However, both contracts emphasize on predetermining the prices to ensure transparency and prevent gharar. It is crucial to understand that the profit margin in BBA is not expressed as interest. Instead, it is recognized as a risk the bank has to bear while providing the deferred payment facility. Thirdly, Islamic finance incorporates salam contract in its transactions. Unlike conventional transactions, salam offers a distinct approach where the delivery of goods is deferred instead of the payment. Salam is a sale where the seller commits to delivering specific goods to the buyer at a future date once full payment has been done, unlike BBA, where the asset is delivered first before full payment is made. In the modern context, the salam contract evolves with time, making it adhere to the Islamic principles. Banks will engage with commodity suppliers, providing funds for their needs in exchange for a future delivery of commodities with a specified weight, size, quality, and quantity. To understand salam deeper on how it emerged, we journey back to the time of the Prophet Mohamed ﷺ, where the aim of this contract is to help small farmers seeking funds for cultivation. Yet, the initial form of salam lacks specificity and resembles a loan with additional charges. In this era of digitalization, salam can be found in online shopping platforms such as Shopee, TikTok Shop, and Lazada, among many others. And these platforms operate on a similar principle, which requires buyers to pay upfront for products that will be delivered at a later date. Next, we are going to discuss on Qard al-Hasan, an interest-free loan in Islamic finance. Unlike conventional loans, the lender's main purpose is to provide financial support to those in need without anticipating any return in the form of interest. The basis of this contract is the concept of mutual assistance. The lender offers a specified amount to the borrower, who is only obligated to repay the principal without incurring any interest charges. This transaction becomes a form of charity, which aligns seamlessly with the Islamic principle of aiding those in need. In the contemporary landscape of Islamic finance, the Qard contract lies in everyday transactions, particularly in deposits. Customers acting as lenders entrust funds to the bank without the expectation of interest charges. The bank utilizes these funds in Sharia-compliant transactions and investments to enhance their financial growth. While the lender does not charge interest, the bank may reward or give appreciation towards the lenders through hibah or a gift. Unlike guaranteed interest rates, hibah serves as a potential return, not predetermined or agreed upon. The bank, in turn, is entitled to any revenue or benefit generated from the use of these funds. Under the terms and conditions, the banks guarantee the repayments of the exact sum deposited without any interest charge upon the lender's demand. This assurance comes into play when the lender chooses to withdraw cash from their savings account, emphasizing the adherence to Islamic financial principles. Lastly, the Musyarakah and Mudarabah contract. These two contracts are fundamental in shaping an organization. Musyarakah, which means partnership, requires multiple business owners known as partners to contribute capital in the form of money, assets, labor, and intellect to run a business together. The profit or loss gained during the year will be shared among partners based on a profit-sharing ratio that was mutually agreed upon upfront. The application of free sharing and equitable distribution of income aligns with the Islamic principles. Mudarabah, on the other hand, is a silent partnership contract where a silent partner who acts as the capital provider will have limited liability in bearing the loss of the business. The silent partner will also not take part in the decision-making process of the organization. The other partners will work together and brainstorm multiple ways to utilize the funds provided by the silent partner.